Hello, good evening, and welcome to Unacademy IAS, a one stop destination for all the English medium civil services aspirants. Welcome to the session 2, where we are going to discuss the 12th class standard, class 12th standard of Maharashtra board chapter wise discussion. Earlier, I've taken one session wherein I've discussed one of the very important chapters from the book, that is national income. Today, we are going to take up the chapter public finance and understand what are the important points, concepts in this particular chapter. Now, before I start, here is a very important announcement. I know a lot of you are preparing for the civil services exams 2027. In order to ace the exams in the first attempt, you need to have a structured approach towards the UPSC preparation. When I say structured approach, you need to have a comprehensive coverage of the static portion, the current affairs coverage, correct reading material, and sufficient number of prelims as well as mains test series. Once you enroll into our courses, you will get access to all of these. Those interested in enrolling, do check out the details by clicking on the link provided in the description below. And if you enroll by the end of today using the code IAS English, the course will be available at a discounted price of 17,999, and starting tomorrow the prices are going to increase. Let me start the discussion. What is the basic idea of public finance? What do you understand by the term public finance? The public finance essentially covers the overall policies of the government which will lead to the expenditure, which will lead to the expenditure as well as revenue generation. And when I use the term revenue in the context of, let's say, government budgeting or government finances or public finance policies, etc., please remember, instead of the term revenue, they will use the term income, or they will simply use the term receipt. Either income or the term receipt. Right? So public finance, again I repeat this, essentially covers the overall policies of the government which will lead to expenditure and which will lead to the income generation for the government. And under the public finance, these are the areas which we will be discussing one after another. First, we will look at what are the sources through which the government will earn the income, what are the sources through which the government will incur the expenditure, and what is the concept of debt of the government, that is the public debt as a concept. Let's understand or decode all of these one by one. Now, starting with what are the sources of revenue generation? What are the sources of income generation for the government? The revenue generation sources essentially are divided into two parts. One is called as the revenue receipts, and the other one is capital receipts. Revenue receipts and capital receipts. And please understand this, whenever you use the term revenue receipt and capital receipt, that is basically the terminology such as revenue and capital in the context of the fiscal policies of the government. Essentially, the term revenue talks about the expenditure or the income of the government. Expenditure incurred or income generated by the government. But whether it is expenditure done or income earned, there is no change in asset or liabilities of the government. There is no change in the asset or liabilities of the government. I'll explain with an example. Please have patience. I'll repeat this. Whenever you use the term revenue, there will be two types. One is the revenue expenditure and the other one is revenue receipts. Revenue expenditure or the revenue receipts basically are the form of expenditure or the income generated, but there is absolutely no change in the assets or the liabilities of government here. And when I'm talking about the government, I'm simply talking about the union government. And there is also a term capital expenditure and capital receipts. Capital expenditure and capital receipts. What is the basic idea? The capital expenditure is the money that is spent by the government, and the capital receipts is the income generated by the government. So whether this particular money is spent or income is generated under the capital heading, whenever it is done, there is a change in asset or liability of the government. Asset or liability of the government. Let me start with some examples so that it is very clear for all of you. Let's say the government of India will incur expenditure and create assets such as roads. I want all of you to give the answer to this question now. The government of India will spend money, create roads. Can I simply say the assets of government of India have increased under this? The government of India, second example, the government of India will own certain companies and the ownership in these companies and now will be sold away, sold by the government of India, let's say to the private sector. So when the government will sell away the assets, that is the companies owned by the government of India, can I simply say the assets of the government of India have gone down. So I hope all of you understand here, whenever you use the term capital in the context of the fiscal policies or public finance policies, capital here would basically refer to the kind of expenditure incurred or income generated where there is a change in the assets or the liabilities of the government. Whereas when you talk about the revenue, there is no change in the assets or, right, let's say the liabilities, but under the revenue, either the government will earn money or spend money. Right, so revenue and capital, let's continue. So sources of income, there are two sources. One is called as revenue receipts and the second one is called as capital receipts. What are the examples of revenue receipts? I'll write it here. The revenue receipts, the best example for this is the tax receipts as well as non-tax receipts. The tax receipts as well as non-tax receipts. Tax as well as non-tax. Let's further divide the tax receipts. The tax receipts are further divided into the direct taxes as well as non-direct taxes. The direct taxes as well as non-direct taxes. What is the basic idea for direct tax? Best example for direct tax is income tax, that is on individuals, corporate taxes, that is on the profits earned by the companies. These are examples of direct taxes. But how do you define direct taxes? The direct taxes are those taxes where the burden of taxation cannot be transferred. The burden of taxation cannot be transferred. If the government will impose a tax on me, that is, let's say, individual income taxes. If I am generating income, part of the income now will be given to the government in the form of income taxes. So taxation imposed on me, taxes paid by me. I cannot transfer the burden of taxation. These are called as direct taxes. What about indirect taxes? Right? It's not non-direct, it is indirect taxes. What about indirect taxes? In case of indirect taxes, once the tax is imposed, the burden of taxation can be transferred. Once the tax is imposed, the burden of taxation can be transferred. Best example, the service taxes, or currently the best example, the goods and service taxes. The government of India will impose a GST on service provider or the seller of the goods. Let's say I'll go to the shop, I'll purchase a product. The GST is imposed by the government on the seller. But this particular seller will transfer the burden of taxation to me when I will purchase the product from the shop, or when I go to the restaurant, eat the food, when I go to the movie, the entertainment taxes are imposed on me, etc. So burden of taxation ultimately falls on the consumer, even though the application, the first point of application is on the goods or the service provider. These are basically called as indirect taxes. So the tax receipts of the government are essentially direct taxes as well as indirect taxes. But why do we classify them under revenue head? Why do we call them as part of revenue receipts? You think of this. Let's say government of India will impose income taxes on you and collect the income taxes from you. Is there any liability created on the government? Liability simply means repayment. There is a burden of repayment that is called as a liability. Is there any kind of a liability created on the shoulders of the government? Does government have to repay the income taxes that they have collected? Absolutely no. So because there is no liability created, and by collecting the taxes there is also no creation of asset. And I know a lot of you will be thinking like this: so the government is collecting taxes, they will use the taxes to construct a road. Here, you are simply looking at two different transactions. Focus only on one transaction, government collecting taxes. So when the government is collecting taxes, there is no creation of assets, there is no change in the assets of the government, and there is no change in the liabilities of the government as well. That is the reason the taxes, the direct taxes as well as the indirect taxes, are covered under the revenue receipts of public financing. Is everybody okay with this idea? Do let me know in the chat section. I like you people to participate and do let me know in case if there is any kind of a doubt. So one kind of revenue receipt is tax receipts. What is other types of revenue receipts? Non-tax receipts. Non-tax receipts. Examples I'll start with now. The non-tax receipts examples are: one, let's say government of India has given a loan to a state government. On this, the government is collecting interest. The government is collecting interest. This is called as interest receipt. The government of India owns certain ownership in companies. We call them as CPSEs, Central Public Sector Enterprises. Now, because the government of India has ownership in the CPSEs, these CPSEs will earn profits. Part of the profit is given to the owner of the company, that is the government of India. Now, when the government will receive part of the profits generated by the CPSEs, that is called as dividend receipt. That is called as a dividend receipt. The term dividend, I'll basically make you understand this now. Dividend. Dividend is a part of the profit that is given to owners of the company. Part of the profits that is given to owners of the company. And when I've written the dividend under the concept of revenue receipt, do not be under the assumption that the dividend receipt is only for the government. Do not be under the assumption that the dividend receipt is generated only by the government. No. Right? Listen to me carefully. The dividend receipts are generated or earned by anybody who owns shares in the company. For example, let's say I've invested in the shares of the company ABC. I've invested in the shares of company EFG or XYZ. If this company makes a profit, part of the profit is taken and given to the shareholders. That is called as dividend. And because the government of India has ownership in the central public sector enterprises, part of the profit is given to the government. That is counted as the dividend receipts here or dividend income. Right? That is one more very important source of income for the government. Third very important source of income for the government is the charges. The charges, penalties, etc. that the government will impose and collect whenever certain services are provided by the government. For example, let's say you will apply for a passport. Right? You will apply for a passport. You will apply for a PAN. You will apply for different forms of, let's say, right, different applications for different services provided by the government. When you apply to get the services, the government of India will be imposing certain charges on you or from you and collecting. These particular charges, right, are counted as a part of non-tax receipts. Another very important source is grants from other countries. Grants from other countries. What do you mean by grants from the other countries here? Listen to me very carefully. One word is grant. You'll come across these words very often. One word is grant. And another word is loan. What is the difference between the term grant and the term loan? In case you receive a grant, there is no repayment. Is the term okay with all of you? Please do let me know right now. When you receive grant, there is no repayment. You have received the money, you will not repay the money. Whereas in case of loans, you will receive today. You will take the money today, but in the future, there is a repayment. In the future, there is a repayment. So loans, there is a component of repayment in the future. Whereas in case of grants, there is no concept of repayment in the future. So when the government of India will receive grants, when they will get the grants from, let's say, World Bank or from United Nations, etc., these are one-sided money, one-sided flows of money. The government doesn't have to repay this, and essentially that is counted as a part of revenue receipts, that too non-tax revenue receipts. Now please do let me know, those who are present in the session, everybody is okay with all these components? Everybody is okay with all these components under the revenue receipts? There is absolutely no change in assets or the liabilities of Government of India. Underline the term Government of India. Right? Now listen to me very carefully. When you look at the revenue receipts and compare this with capital receipt, we'll discuss the types of capital receipts now. When you compare with capital receipts, please observe this. When I discuss capital receipts, there is either a change in the asset or the liabilities of Government of India. Right? There is either a change in assets or liabilities of Government of India. And the same is not observed under revenue receipts. Let me start. Capital receipts. Example. Capital receipts. Example. Okay. Under capital receipts, first one, recollection of loans or recovery of loans. Recovery of loans. Right? What is this idea of a recovery of loans? Let's say central government has given loan to the state governments, right? Back in the year 2010, 2015. Now this particular loan will be recovered by the central government today. This particular loan now will be recovered by, recovery means the loan amount will be collected back by the central government today. This is basically called as one of the capital receipts. This is one example. Second example, disinvestment. Second example, disinvestment. Now, what do you mean by disinvestment here? The Government of India will have ownership in many of the companies. That is basically assets. Government will have ownership in the assets. Now, the ownership will be sold in the market. How much of the percentage of ownership is sold? That is left to the government. But the government will sell the ownership of this particular company or the entity in the market. Now, this particular process of selling of ownership to generate revenue, to collect the money, is called as disinvestment. I'll give you a couple of examples here. The Government of India has or had 100% ownership in LIC. Life Insurance Corporation. Life Insurance Corporation. So 100% of LIC was owned by the Government of India. The Government of India couple of years ago sold around 5% of LIC to the market and received money from the market. Right? This is basically one example of disinvestment. Is everybody okay? The idea is clear to you. You sell off ownership in the assets that are owned by you and then collect the money, that is called as disinvestment. And there is one more. There is one more very important component in capital receipt, that is the government will borrow. The government will borrow. The government will borrow from the market. When the government will borrow from the market, essentially what is going to happen? When the government will borrow, it will get the money now to use for current year's expenditures. Right? It will use the money for current year expenditure. And the reason why the government generally borrows, the reason why government borrows is very simple. in one financial year. What do you mean by financial year? Any time basically considered as a financial year in India, the time period between 1st of April between 1st of April to right 31st March. The time period between 1st of April to 31st of March is called as a fiscal or is called as a financial year. Now, in this particular financial year, the government of India has to spend money. The government of India has to collect money, has to earn, has to spend. But generally, what happens is the expenditure that is incurred by the government will be much greater compared to income generated by the government. There is a shortfall, there is a shortage. And because there is a shortage, the government will be forced to borrow from the market. Now, please do let me know everybody is okay with the first, second, and third here. Under the capital receipt, everybody is okay with the first, second, and third. Now, what I want you people to do is essentially observe. Can you see under the capital receipts, there is either the change in the assets or liabilities of the government of India. There is either a change in assets or the liabilities of government of India. That is, under the capital receipts, the liabilities are increasing and the assets are going down. I'll repeat it and please remember this. Please remember this, UPSC or for that matter any competitive exams, they have the habit of asking these kind of questions. I'll repeat it. Under capital receipts, the liabilities are increasing and the assets are decreasing. That is exactly what you will see under the capital receipts. Let me make a comparison now. Please compare that with revenue receipts. Compare that with revenue receipts. Is there any change in assets of government of India under the revenue receipt? Is there any change in the liabilities of government of India under the revenue receipt? Absolutely no. Right? The revenue side essentially deals with the expenditure incurred or income generated during the day-to-day operations. Simple. What does the revenue account or the revenue side contain in the public financing? It will contain expenditures incurred by the government or incomes generated by the government during the course of day-to-day operations. During day-to-day operations, government will spend or collect. There is no change in assets or liabilities of government of India. Now, there is one student who was asking me, sir, why 7007 PK by the way, why the interest receipts are part of revenue side? Why the interest receipts are part of the revenue side? Let me explain this. Imagine, right? Imagine the government of India has given the loan of 1 crore rupees to a state government. I am explaining why interest receipt is part of revenue receipt now. Imagine the center has given a loan of 1 crore rupees to a state government. Annually, the state government has to pay 10% rate of interest to the central government. Now, how is the rate of interest paid? The rate of interest is collected by the government and none of the principal amount, none means 0 rupees of the principal amount is collected annually by the central government. That is, if the loan is given for, let's say, 20-year duration, if the loan is given for 20-year duration, till the end of 20 years, the loan will remain 1 crore rupees. The liability for the state government, loan repayment value will remain 1 crore rupees. But annually, the state will keep on paying 10% rate of interest to the central government. So the central government will collect the interest receipt, but the liability still remains 1 crore rupees, which will be completely paid by the state government after the end of 20-year tenure. That is the reason the liability still remains the same. Liability doesn't change for the state government. Asset value for the center, because the loan is asset for the center. Asset value for the center doesn't change. That's the reason interest income received, interest payment done by the central government will be under the revenue side, not on the capital side. Now the concept is clear. Now the whole issue is clear why it is kept on the capital revenue side, why not on the capital side. Now these are different transactions under the revenue side, under the capital side. That is specifically receipts. And under the capital receipts, when the center will recover the loan, the assets of the central government will go down. Until now, this loan was considered as an asset. Now it is not asset anymore because the center has recollected the loan. Asset will go down. Disinvestment, government is selling the ownership. Assets will go down. Borrowings, the government is borrowing, basically taking money from the market. The liabilities of the government will go up. So assets will go down and liabilities will increase. Is everybody okay with the concept of revenue side now? Right, revenue and capital, that is basically the receipts. Basically the receipts. Just to give an idea what is happening in the discussion, we are talking about public finance. We are talking about public finance. And under public finance, essentially I said there are three very important components. One is basically the overall expenditure incurred by the government. Second one is the total income generated by the government. And the third one is essentially to do with public debt. There is a term called as public debt. We will understand the public debt once we cover the expenditure as well as the income. Now within the expenditure, I said there will be revenue expenditure. There is capital expenditure. And under the income, there is a revenue receipt. There is a revenue receipt and then there is a capital receipt. So far what we have done, what we have covered is essentially, if I number them as 1, 2, 3 and 4, we have covered 3 and 4. We have simply covered third as well as the fourth. Now let's cover first as well as the second. Let's cover the expenditure side of the public finance. Under the expenditure side, again you have revenue as well as capital. And the basic idea remains the same. The basic concept is the same. Under revenue expenditure, government will spend money. Government will spend money. It doesn't change any assets or the liabilities of the central government. I'll repeat the statement. Under revenue expenditure, the government will spend the money, but it doesn't change any asset or the liabilities of the central government. Whereas under the capital expenditure, the government will spend money and this will change the assets or the liabilities of the central government. How so? What are the different examples? Let's understand one by one. Let me start with the revenue expenditure now. Let me start with revenue expenditure. Under revenue expenditure, the government will incur lot of welfare expenses. The government will incur lot of welfare expenses. Let's say Government of India will launch an initiative to provide health care for the poor people. The government will launch an initiative to provide subsidies for the farmers. The government will launch an initiative to provide for, right, let's say a certain amount of assistance for the households, etc. So there are a lot of social welfare initiatives that are launched by the Government of India. Under this, the Government of India will keep on incurring expenditure without any change in assets or liabilities of the Government of India. Social welfare expenses. Second very important component, the salaries that are paid by the government. The salaries that are paid, that is the operational cost that is incurred by the government. The day-to-day operations which are incurred, a salaries component of the government employees, the salaries. And the third one, interest payment. Interest payment that is incurred by the government, that is when the center has taken the loan. On this, right, basically the government will pay, right, interest. And I hope all of you understand now. Please do let me know all of you understand. Interest paid or interest received will always be under the revenue side. Earlier, interest received was part of revenue receipts. Now, interest paid will be part of revenue expenditure because the liability or the assets of the government do not change. It will be on this side and this side. Right? Now, there is a question. Freebies also come under revenue expenditure. Any kind of freebie. By nature, freebie means a subsidy given by the government. Subsidy is announced by the government. Let's say government will give you cash of 500 rupees every month. Government will give you 6,000 rupees money every year. All of these particular freebies or the subsidies are part of social welfare expenses. They will be under revenue expenditure. They will be under revenue expenditure. Now, there is one more very important component, slightly technical. Listen to me carefully. Grant for creation of capital assets. Grant for creation of capital assets. Slightly confusing because you are coming across capital assets, etc. under this component. Now listen to me very carefully. What is grant for creation of capital assets? Let's say the central government will directly spend 100 crore rupees and construct road, will construct an infrastructure, will develop an asset. Now in this example, I'll call this as example A. Now I want your answer. In example A, can I simply say the assets of central government have increased? Right? Listen to me carefully. Can I simply say central government will directly spend 100 crore rupees and construct road? Can I simply say the central government assets have increased because now the road will become the asset of the central government? But what if I simply say central government will provide the 100 crore rupees, let's say, to the state government? The state government will use the 100 crore rupees, develop an asset. The state government will use the 100 crore and develop an asset. Now tell me, in example B, I'll write this as example B. In the example B, has the central government's assets changed or have the state government's assets changed? Do let me know the answer to this question. I'll repeat it again. In the example B, has the central government's assets changed or the state government's assets changed? Can I simply say in the example B, it is the state governments whose assets have changed, not of the central government. So this is basically a type of grants for creation of capital assets. Central government has given the money. This money has been utilized by another authority to develop infrastructure, create asset. So it is not the central government whose assets will change. Central government has given money, but their assets are not changing. But some other authorities' assets have changed. Hence, this is classified as a grant for creation of capital assets under revenue expenditure. Is everybody able to understand this? Do let me know. Why it is kept under the revenue, right? Why not under the capital? Because we are talking about the central government's assets. Central government's assets are not changing at all. That is the reason. Can we go forward? These are the examples under the revenue expenditure. What about capital expenditure? What is the components under the capital expenditure? What are the different types of capital expenditures? First one, the expenditure that is incurred by the government for development of infrastructure. For the development of infrastructure, the government of India will spend money and develop infrastructure. So can I simply say here, the assets of the government, I'm talking about capital expenditure, I'll write it on extreme right side, top extreme right side. Under capital expenditure, the government will spend money to develop roads. Can I simply say the assets of the government of India are increasing? Correct? Assets of government of India are increasing. Another example of capital expenditure is The government will repay the loans that they have borrowed. Government will repay the loans that they have taken. Let's say back in the year 2010, Government of India had taken a loan of 100 crore rupees. In the year 2026, this loan amount will be repaid by the government. So, can I simply say now there is a decrease in liabilities of the government? There is a decrease in liabilities of the government. So, assets are increasing or liabilities are decreasing. That is essence of capital expenditure. I'll give you one more example. Let's say the central government will give a loan for 50 years. Central government will give a loan for 50 years to the state government in the year 2026. If the central government will give a loan this year, can I simply say loan is nothing but asset for the government of India. So the loans which are loans issued to the borrowers from the central government this year are counted as a part of capital expenditure. But in simple terms, what happens under the capital expenditure? Either the assets will increase or the liabilities will decrease. Assets will increase or the liabilities will decrease. This is exactly what happens under the head of capital expenditure. Is everybody okay with the discussion here? Please do let me know. Please do let me know. Everyone is clear what is going to happen when the assets will change, when the liabilities will change, what is going to happen, etc. Now let me give you a simple table. Memorize this particular table. Please memorize this particular table. You have revenue expenditure. You have revenue receipts. RE is revenue expenditure, and RR is the revenue receipts. Revenue receipts. In addition to this, you have capital expenditure. You have capital expenditure and you have capital receipts. How do you remember what is going to happen in terms of assets and liabilities? Please memorize this particular table. Memorize this particular table. Now the other two columns will be what will happen to assets, what will happen to liabilities. Assets and liabilities. Let's start. So in the context of revenue expenditure and revenue receipts, it will be not applicable. It will be not applicable. Correct? Everybody is okay? Because under the revenue receipts and revenue expenditure, there is no change in the assets and liabilities of the central government. But what about capital expenditure and the capital receipts? How do you remember it? Right? Please remember with this example. Capital expenditure, just remember example of Government of India constructing road. Simple. Government of India spending money and constructing road. Now when the Government of India will construct the road, assets of the Government of India will increase. Yes? Everybody is okay? Under capital expenditure, assets of Government of India increases. And whatever will happen in terms of assets, exactly opposite will happen in liabilities. Whatever will happen under the assets, exactly opposite will happen in liabilities. So under assets, if it will increase, liabilities will decrease. And how do you understand what will happen in capital receipts? Whatever is happening for assets and liabilities in capital expenditure, exactly opposite arrow marks are going to take place or happen, exactly opposite is going to happen under capital receipts. That is, for capital expenditure, assets are increasing. For capital receipts, assets will decrease. For capital expenditure, liabilities are going to decrease. For capital receipts, liabilities are going to increase. Is everybody okay with this particular table now? Do let me know. Those present in the session, please do let me know. Everybody is okay with this particular table? My suggestion, please memorize this particular table. Please memorize this particular table. UPSC or for that matter, any civil services exams, even other competitive exams, they have the habit of questioning you as to what will happen when the assets and liabilities will change under which kind of a heading. Done? Right? So we have taken care of the revenue receipts, we have taken care of revenue expenditure, capital receipts and capital expenditure. Now, right, I use the term borrowings of the government. Listen to me carefully. There is one more concept associated with this, that is deficit. Right? I'll discuss now deficit as well as debt. Deficit as well as debt. Two important concepts. One is the deficit and the other one is debt. And when you use the term deficit, most of the times they will be referring to fiscal deficit. Most of the times they will be referring to fiscal deficit. But is the deficit only fiscal? When you use the term deficit, is it only right in the context of the fiscal deficit? No, there are other forms of deficit as well. For example, in addition to fiscal deficit, we have revenue deficit. We also have revenue deficit. Right? In addition to revenue deficit, there is effective revenue deficit. There is primary deficit. What is the basic idea? Fiscal deficit simply refers to the borrowings that are done by the government in that financial year. The borrowings that are done by the government of India in that financial year. Let's say in the current financial year, that is the financial year 2026. We are currently in the financial year 2026, by the way. That is, it has started from 1st April 2025 and it will go until 31st March of 2026. So we are in the financial year 26. So in the financial year 26, if the government of India will spend 100 crore rupees and if it will earn only 70 crore rupees, there is a shortage, there is a gap. This particular shortage will be filled by the union government by borrowing from the market. By borrowing from the market. And this is essentially called as fiscal deficit. The government keeps on borrowing every year. So every year there is a fiscal deficit that is calculated. And whenever you come across these particular deficits, you will get the data where they will give you absolute borrowings. Absolute borrowing means in terms of rupees, how much is the borrowing. But more importantly, when you talk about all of these indicators, these are also given as a percentage of GDP. As a percentage of GDP, gross domestic product. What is a gross domestic product? The market price of all the final goods and services which are produced within the territory of a country for a specific time period. So these are generally given, right, in the percentage of GDP. Right? So that will be more important for you rather than remembering the absolute numbers. Absolute numbers could be 15 lakh crore, 91,000 crore rupees. That is not possible for you to remember. But you will be able to remember as a percentage of GDP, 3.5%, 3.9%, 4.3%, 4.5%, etc. So first one is fiscal deficit. That is how much is the borrowings done by the government in a financial year. Fiscal deficit. Then I said there is revenue deficit. What is the basic idea for revenue deficit? The total revenue expenditure minus the total revenue receipts. The total revenue expenditure minus the total revenue receipts. The shortage in this case, that is by how many rupees you are spending more money under the revenue expenditure head compared to the income earned under the revenue receipts. This is called as revenue deficit. And please remember this, India has a revenue deficit. India has a revenue deficit. But the market following or market theory simply says, that is a golden rule in the market simply says, if you want to borrow from the market, you should not be borrowing for consumption purposes. You should be borrowing for asset creation purposes. I'll repeat the statement. When you borrow from the market, you should not borrow for consumption purposes. You should borrow for asset creation purposes. Now, what generally happens in the context of the revenue deficit? You're borrowing for consumption purposes. There is no asset creation under the revenue head. There is asset creation only under the capital head. That is the precise reason the government of India, when you look at the targets which are set up by the government of India wants to reduce the revenue deficit to 0% of GDP. In a nutshell, the government of India wants to spend the same amount of money under the revenue head when it is compared with how much income it generates under the revenue head, so that it doesn't have to borrow from the market for consumption purposes. Fiscal deficit, yes, they will have a target of 3% of GDP because they want to borrow so that the asset creation will happen. But revenue deficit, they want to reduce it to 0% of GDP. Everybody is able to understand the concepts here. So one is the fiscal deficit and the other one is the revenue deficit. But in addition to this, you'll also come across the term debt. Debt to GDP ratio, they'll say. Or they will use the term public debt. They will simply use the term public debt. What is the basic idea of a public debt? Public debt basically refers to how much is the borrowings that the government of India has to directly repay. Very simple. How much is the money that the government of India has borrowed? How much money the government of India has to repay by taking the money from the consolidated fund of India. That liability, that representation of the debt is called as public debt. Now, when you say public debt, there are two components in the public debt. There are two components in the public debt. One is called internal debt. One is essentially the internal debt, and the second one is the external debt. Internal debt and external debt. And before I start with internal and external, some of you will be looking at the term debt and will be getting confused with the idea of fiscal deficit. Fiscal deficit represents how much money I am borrowing this year. Of course, I'll have to repay it. How much money am I borrowing this year? That's a fiscal deficit. But debt represents how much money I owe. How much money I will have to repay. That is basically the public debt. And I know somebody will be thinking, sir, it is one and the same. If you borrow, you will have to repay. So don't you think the numbers are one and the same? Not necessarily. Listen to me carefully. Let's say in this year, I will borrow 100 crore rupees. This year, I will borrow 100 crore rupees. Can I simply say the fiscal deficit for the year 2026 will be 100 crore rupees? Now, last year also, I have borrowed 200 crore rupees. Right? That was done in 2025. I am yet to repay this amount. I borrowed 300 crore rupees in the year 2024. I am yet to repay this. Now, please tell me, can I simply say in this context, the example, the numbers that I have written here, in this context, the fiscal deficit for the current financial year is 100 crore rupees. But the debt that I owe to the market, the debt that I owe to the market, assuming this is the only borrowing, the debt will be 300 plus 200 plus 100, 600 crore rupees. So the debt is the total amount that you will have to repay taking the money from the consolidated fund of India. Whereas the fiscal deficit represents how much money you have borrowed in the current financial year. Is everybody able to understand? Can I move on to the next concept now? Public debt is divided into two parts. One is called internal debt and the second one is external debt. What is the basic idea? Whenever you borrow from the domestic market, whenever you are borrowing from the domestic market, you have to repay this particular amount of money. This is called as internal debt. And when you borrow from the external market, let's say you have borrowed from World Bank. You have borrowed from BRICS Development Bank. You have borrowed from Asian Development Bank. In such cases, this will basically be counted as external debt. Now, in the context of India, how much is more? Which side is the greater one? Which side is the larger one? Is it internal debt or external debt? In the context of India, 95% of the public debt, 95% of the debt of the government is essentially internal in nature, and hardly 4 to 5% will be external debt. Everybody is able to understand? So internal as well as external, most of it is internal in nature. And those who are wondering, sir, why do we have most of the debt in the form of internal debt? Reason the government of India simply says is, when you borrow from the domestic market, you will have to repay in rupees. And that is easy for the government because the domestic currency is also rupees. But if you borrow from the external market, now you will have to make the repayment in the form of dollars. Right? So that kind of exchange rate risk, because the value of rupee against the dollar will keep on falling over a longer period of time. It has fallen over a longer period of time. So repayment will be controlled when you borrow in the form of rupees within the domestic market and repay in the form of rupees within the domestic market. Done? So most of the debt will be internal, very small part will be external. So there you go. I've covered all the important components of the public finance. All the important components. Have a look at the chart here. We have covered the concept of public expenditure. We have covered public revenue, public debt, the fiscal policy, as well as the revenue expenditure, which talks about the debt policy of the government, the public debt of the government, etc. Right? So these are the important concepts I wanted to discuss with you people in this particular session, where I've taken up one of the important chapters from class 12th book of Maharashtra board. Tomorrow I'll be taking up one more session, that is same at 6 p.m. Tomorrow and day after tomorrow I'll be discussing two more chapters from the same 12th standard book of Maharashtra board. If you have liked the session, do not forget to hit the like button. If you're yet to join our YouTube channel, kindly do it right now. Thank you. Have a great day. See you tomorrow sharp at 6 p.m.